What if I told you modern power isn't built on gold, it's built on credit lines? Today, governments raise trillions by selling bonds. Markets reward some countries and punish others. Interest rates move, currencies shake, and entire societies feel it, in rent, food, jobs, and debt. But this system didn't appear naturally. It was assembled, piece by piece, in a Europe that didn't have the institutions we take for granted today. And before central bank policy became the language of power, there was a different era, when private financiers could decide whether a government could breathe. This isn't a story about a family secretly ruling the world. That's the lazy version, and it's often used to sell prejudice instead of understanding. This is a story about how a new financial operating system was built, how information became a tradable advantage, and how late 1700s Europe looked powerful on paper, empires, crowns, uniforms, flags, but behind the scenes, most states had the same weakness. They were always short on cash. Armies weren't just soldiers. They were payroll, logistics, food supply, weapons contracts, transport, bribes, and emergency purchases. War didn't just cost money, it demanded money at the worst possible time. And in a world without modern taxation systems, without fast banking infrastructure, without instant settlement, the biggest challenge wasn't winning battles. It was staying funded long enough to fight them. So rulers needed a partner who could do three things. Raise large sums quickly. Move value across borders. In Frankfurt, a young merchant named Mayer Amschel Rothschild began in trade and coin dealing, a business that taught him something more important than metallurgy. Money is not just metal. Money is trust plus logistics. If you can source rare coins, verify them, price them, and place them with the right buyer, you're already in the trust business. But Mayer understood a larger upgrade. The bigger game wasn't owning coins. It was arranging finance for people who needed discretion and speed. Through connections with elite clients, including the House of Hesse-Kassel, Rothschild moved from dealing objects to managing flows, payments, storage, transfers, and eventually large-scale finance. And then Europe caught fire. Here's the strategic move that separates this story from a normal banking success story. Mayer didn't try to dominate one city. He built a family network across multiple capitals. His sons established major operations in key financial and political centers, effectively creating an early multinational financial organization at a time when borders were slow, warfare was constant, and communication was fragile. This mattered for one reason. A single city can be crushed by war, invasion, bankruptcy, or revolution. A network can route around chaos. If one market froze, another could still function. If one government collapsed, another still needed funding. If one currency weakened, another remained strong. That's not just ambition. That's risk management before the term became mainstream. And in the age of Napoleon, during the Napoleonic era, governments weren't just fighting, they were improvising national survival. Britain, for example, didn't merely fund war. It funded alliances, subsidies, supplies, and global logistics. Those payments had to cross borders and reach partners at the right time. That's where private financiers could step in, not because they had secret magic, but because states were bureaucratic and slow. The Rothschild network was particularly good at coordinating cross-border payments, sourcing bullion and settling accounts, creating reliability in a chaotic environment, and using fast couriers to reduce uncertainty. And in finance, uncertainty is expensive. When markets don't know what's happening, they demand higher interest, or they stop lending entirely. So the ability to reduce uncertainty, even by hours or days, can move prices, and change outcomes. You've probably heard the famous story. Nathan Rothschild learns about Waterloo first, triggers panic, buys cheap, becomes rich. That tale has been inflated for generations, partly because it's dramatic, and partly because people love simple villains. But strip away the cinematic version and the real lesson remains. In that era, being faster at receiving reliable information could create a measurable edge in markets. Not mind control. Not sorcery. Just speed plus credibility plus capital. And after the Napoleonic Wars, another shift happened. War financing didn't disappear. It transformed into something more permanent. In the early 1800s, sovereign borrowing became more standardized. Governments increasingly sold bonds to raise money, refinance obligations, and stabilize budgets. The Rothschilds didn't invent government debt. But they became leaders in making it scalable, distributing bonds, connecting investors to states, and helping structure large issues. They were involved in major loans and projects across Europe, including financing tied to infrastructure and industrial expansion, railways, mining, and large state-backed development. Here's why that matters. Infrastructure isn't just progress. It's political power turned into steel. Railways unify territories, move troops, move goods, and integrate economies. Mining feeds industry. Large projects decide which regions rise and which stagnate. So when ordinary people watched governments borrow, crisis after crisis, they sensed something real. Power was migrating. Not away from kings entirely, but away from old symbols of power. If a state couldn't borrow, it couldn't function. If it couldn't function, it couldn't govern. And because debt markets rewarded discipline and punished instability, politicians began living inside a new constraint system. That's when rumors explode. Because when the mechanism is complicated, the public fills the gap with stories. Some of those stories turn toxic, especially when they scapegoated Jewish families and reduced structural forces to a single, hidden hand. By the mid to late 1800s, the world began changing in a way that naturally reduced any single family's dominance. Financial markets deepened. More banks scaled up. Communication technologies improved. States built stronger fiscal systems. And central banking became more structured. In other words, what was once rare expertise became institutionalized. The private dynasty era gradually gave way to an era of organized financial infrastructure, where power sits more in systems than surnames. Then the 20th century hit like a wrecking ball. Here's the paradox that makes this story worth telling. Even as the Rothschilds became just one respected name among many, the machinery they helped professionalize kept expanding. Sovereign bonds became foundational. Global capital became faster. Information networks became constant. And interest rates became political destiny. So if you want the real takeaway, it's not fear a family. It's this. When a society normalizes permanent borrowing, it also normalizes permanent dependence on whoever provides, prices, and distributes capital. That's not a conspiracy. That's a structure. And structures don't need villains. They run themselves. So what's the lesson here? Don't get hypnotized by the cartoon version of history, the idea that everything is controlled by a single bloodline. That story is easy to sell because it gives you a simple villain. But simple villains are usually a distraction, so don't chase myths. Chase mechanisms. Because money isn't neutral. It's a rulebook. And the most dangerous position in any society is living by rules you don't understand. If this episode changed how you see finance, subscribe, because the next stories get even darker. Next, we'll look at how central banks inherited this power, and how the modern world quietly became an interest rate civilization, where a single percentage point can decide who thrives and who breaks.